I know I'm about a minute or two early, but I've got about an hour and a half presentation in 45 minutes. You're going to think that this is a fire hose that you're having to drink from, so get ready. I got a lot of information. What we'll do is I'll go through this as quickly as I can, and then at the end, I know that the reception is after this, but if anybody wants to stick around, because there's no programming after this, I'll be glad to stick around. Try to answer any questions you might have. I always like to start with a picture. I've had a picture for years that's been my motto of marketing, but I changed it this year to this one, and as you can see, you got this guy who's actually in ski boots on a rail, getting ready to ride the, there you go, getting ready to ride this roller coaster. You can see he's got handles right there that he's holding on to. And over there in the distance is his crop. And so his bottom line is, this is safer than farming rice. I think that's pretty much true as we head into this year. If you've never seen me before, I hold an MBA from A&M, an undergrad degree in ag economics there also. Managed a 5,200-acre rice, wheat, and corn farm. I was a licensed Chicago Board of Trade floor trainer from 1989 through 2011. I didn't trade all the time there. I went up about 6 or 8 times a year and would go up and spend a week at a time and trade. Private instrument pilot, just in case you have some interest along those lines. Division 5 high school football official, NCAA. Well, that's a long time ago.
Race car driver.
Market analyst. There's a lot of things I'm not putting up there, just in case. Just so you'll know, anytime anybody talks about the market, they're going to talk their position, so there's mine. So you can look at it real quick and you can see 100% sold to rice. This is what I'm talking about here. But we pretty much got the crop sold out in time up above, but it is a tough one to say the least right now. Okay, my view of trading, as I'm risk adverse, that's why I'm a risk analyst. I look at the market from a standpoint of what's the risk, try to figure it out. I'm a technician and a fundamentalist. That means that I follow the little lines. I know the fundamentals. I'm an absolute fountain of useless information. But for the most part, I like to follow the little lines because I believe they tell you a lot. And we'll talk a little bit about that in just a minute. I'm a hedger, not a speculator. I believe that marketing is a marathon. It is absolutely not a sprint race. So if your marketing plan is a sprint race where it means you just get this wild hair one morning and sell the crop, it's probably not a really good plan. So it's a marathon, and that's how I try to develop a long-term plan with that. I'm a student of market psychology. Absolutely love to read everything I get my hands on about psychology in the market. And then, of course, I have more of a floor trader's approach. That doesn't mean a heck of a whole lot other than the fact that I believe that the intraday action is important, but intraday is also extremely important, and I follow that really closely. When we look at market analysis, we're going to look at risk analysis. We're going to look at 3 main steps. Think of it as a stool. You're sitting on a stool right now, it's got 4 legs, but if you were sitting on a stool with 3 legs, you know if you lost 1 leg, it's not going to be a very steady stool. So these are the 3 legs that I believe you have to know in order to understand what's happening in the marketplace. You have to know the economic environment that you're working in. We're going to talk about that. The fundamentals of the market, we'll go over that. And then you really need to have an idea of what the technicals are. I can tell you that the people who trade this market do not trade the market based off supply and demand sheets. They trade off of technical indicators. Your biggest drivers today in the market are the computers. Believe me, the computers do not know what the fundamentals are, but they have a very good idea of what's happening from a technical standpoint. So you need to have an idea what the technicals are as well. Knowing these 3 things will help you get a very clear picture of what the risk is in the market. And once you know the risks, you can control them, like this guy who's controlling his risk with those posts right there. Anybody want to get in there with him? Yeah, I didn't think so. So we're going to start with the economic environment. We're going to go through this pretty quickly, but let me just tell you that in a capitalist society, this is the economic cycle. We have a expansion and growth in the market, then there's a crisis in our economy, and then there's a recession, and market fear develops. And what will happen then is the government will come in and they will make a response, and then there's a recovery. Right now we're in an expansion growth phase. Now this expansion phase right now has these characteristics. We've got manufacturing that is weakening. We've got commodity prices that are way too low. All commodities, not just rice, but everything is too low in this category. China has a slower growth than what was expected for them at this particular point in time. So we've got some negative things in the expansion phase, but then we also have these positives. The consumer remains very strong. We're seeing the confidence growing. Housing market is robust, at least for existing homes, not new home sales, but existing home sales. We're seeing robust sales there. Wages are up year over year. They were steady in the last report which just came out. And unemployment rate continues to be low. 5%, it's the lowest it's been in many years. So in the economic environment, when we look at these three conditions, we'll get a better picture of what it is. So let's start with the employment conditions. Here's a guy that's got a job. I don't know, I would like to see him do this part of that hedge. That would have been the part. When we look at the unemployment rate, if you look at this slide, what it does is it shows you what happens to employment during recessionary periods of time. Between these blue lines is the areas of expansion, and the blue lines that you see go up and down, those are periods of recession. And one of the things you'll notice real quickly is during every time there's a recession, we have a spike in unemployment. Every single one. I could go back all the way as far back as you want to go in a capitalist society. It's going to be kind of a golden rule. But if you're going to have a recession, you're going to have a spike in unemployment. But look what's happened to unemployment since the big recession that we had in 2008. You see that it's fallen down to a 5% level. When we look at people who have been unemployed for over 26 weeks, that number is still high compared to previous years, but it's way down from where we were back in 2009. When we look at part-time for economic reasons, these are people who go out and got 2 part-time jobs. One of the reasons they couldn't get 1 full-time job is because of benefits. We had problems with the health care, as you all know. And so what we saw was guys going out and getting 2 part-time jobs. But that has begun to decline as we've seen the economy pick up and more job growth has occurred. When we look at new homes versus existing home sales, we've had this, they followed along almost perfectly for years and years and years. But since the 2008 recession, you can see we've had this gap where existing home sales have been doing good, but new home sales have not been doing well. The reason that is important from an economic standpoint for our own economy is because new home sales is a main driving force for unemployment. Employers, when you have a robust new homes being built, there's a lot of employment going on. When we look at new home sales and the recession, you can see we had this big run up. There's the bubble. It crashed, and now we've come back up to what would be considered a low level in previous years. So the unemployment rate, when we really look at this and we see how these spikes occur, there's also a recession cycle that goes with that. If we go back to 1960, that recovery there, the period of time from recession to recession, was 9 years. If we just go ahead and let this fill in, you'll see that the differences range anywhere from 2 years to 10 years. The average of those is 6.5 years. And in fact, if I take out the high and the low, the average is 6.5 years. How far are we at right now? You guessed it, we're 6.5 years. For the last 3 years, as we've talked about this, and I've been speaking, I basically tell people right now there's not a whole lot of risk of recession, but I can tell you now that is no longer the case. And in fact, you probably hadn't heard a whole lot from anybody about recession, but in recent months, I know that you've started to hear people talk about, we may be headed for a recession. If you didn't hear, the stock market was down 369 points today. So there's a lot of people talking about, hey, we may be in a recession. What we've been saying is in agriculture, we're in a depression. So we understand what's going on. So employment conditions, when we look at that, it's slow but steady growth, and improvements likely through 2016, but low oil prices are historically good for employment. And there's another but there, and that's this. History says, this is just what history says, that higher unemployment is likely in the next 3 years with at least a minor recession. That's what history says. Let's look at the GDP. We've done the economic conditions, GDP outlook. It looks pretty good. You see we had the big spike in the second quarter of 2015. Third quarter, half. But here's the projection for the fourth quarter. Yeah, it's not too good. Now all of a sudden they're talking about this first quarter of 2016 being a negative. If we get 2 of them as a negative, it would be the definition, what most people classify as the definition of a recession, is 2 periods below 0 as far as the GDP goes. Here's the non-manufacturing ISM index. This is a big one to follow. It shows you how the manufacturing's been running. We got this little spike in 2014, and now we're back down to this 55 level. If it drops under 52, we probably will start to hear people talk about recession. So when we look at GDP, it supports the current expansion. There are some signs of GDP slowing, some sign of our economy slowing, and it's going to be interest rate dependent. With that said, here's the interest rate picture. I've been using this slide for a long time, just keep adding on to it, but this slide is a slide of what we call ZIRP. Remember that? Zero interest rate policy. That's what the Fed's policy has been. Zero interest rate. We've had that for a long time, since all the way back to 2008. You can see the Fed, how they continually cut rates. But of course, as you know, 7 years of ZIRP has come to an end. So let's talk about Fed and inflation, just so you know. The Federal Reserve has been mandated by Congress to promote two things. Those two things are, first of all, price stability, and the second thing is maximum employment. So the question is asked, well, what is that? Well, the FOMC came out and told us what it was. They said that in order to have price stability, we need to have the PCE, that's the personal consumer expenditure rate, be 2%. That means that your inflationary rate of what you spend money for on everything would go up about 2% a year. That's what they would classify as an acceptable rate of inflation, or the PCE rate. They've also said that in employment, they consider full employment between 5 and 6%. I don't think they ask anybody who's unemployed if that's full employment, but we know that that's what they have classified it to be. So where are we right now? Well, the PCE index right now is 1.33. Last year when I spoke here, it was 1.5. The unemployment rate, it was 5.9 last year, but it's now 5%. And under 5% is considered to be inflationary. As I traveled around this last year, and especially as we headed for the end of the year, I started asking the question everywhere I went, do you believe the Fed is going to raise interest rates on December the 16th? Overwhelmingly, the answer was no. And yet when I looked at the unemployment rate, I said, well, the answer is going to be yes. They have to. And if unemployment were to have dropped in the unemployment numbers that came out last week, I would have told you in the first quarter going forward, this very next event, they're going to raise it again. But they didn't lower the unemployment rate. So this is where our situation is right now. When you look at it from a standpoint of how the unemployment moves, in this area right here, that's considered full employment. Below that is considered inflationary. That means there's too much money in the system. The volatility is going to pick up, and that's going to create inflation. So one of the things you'll hear about them talking about is, are they seeing any price inflation? They're not yet. They haven't seen any of that so far. But that's what happens when you have a very low unemployment rate. But anytime it's above that 6%, then it can be recessionary in its pressure. So we've had liftoff. The Fed has lifted the rate, and probably, the consensus is they'll lift it 3 or 4 more times this year. I'm not sure they'll do that, but that's what the consensus is of many economists. So here's what we can say: we will ZIRP no more, at least not right now. Current PCE suggests no inflation, but current unemployment suggests that there is some inflationary risk in our economy. Federal Reserve has no tools, very few tools for deflation. That's the thing they fear the most, because there's only one thing they can do if there's deflation, and that is to turn on the printing press. That's all they can do. So the ZIRP has said, or the Fed has said that ZIRP will be the support for the market until the labor market recovers, and at 5%, they consider it to have recovered. As long as the interest rate is near 5%, the Fed will be under pressure to continually raise interest rates. So that's the GDP, the unemployment conditions, the interest rate picture. We've got some upward pressure on interest rates. Frankly, for me, it's the speed with which they increase the interest rates is going to be, I think, as big a factor as anything. And inflation on the Fed's radar, but it's only a small blip right now. They're watching it closely, but nothing is there at this point. So when we look at the economic cycle, we're in expansion, we're seeing growth, but we're seeing signs of weakening. The problem here is that, guess what's next? Guess what's next? Now, it may not be a big one, maybe a small one, I don't know. But we're headed towards this next phase of our economic cycle. So that puts us in this situation. This guy is on, this is an aluminum ladder. That is a swimming pool that he has it set up in, and that is an electrical cord that goes up to a drill. And he's barefoot. So we're not working in the safest of conditions anymore, are we? Okay, ag markets and the economy. Just to talk a little bit about the ag markets in this economic environment. We've got a new paradigm here. If you haven't heard me talk in the last couple of years, this has been one of the things that I've pretty well been talking about for the last year and a half, and that is the energy market. There is a total new paradigm going on here, and the results are bearish for commodities, including agriculture. This is the way the world was looked at in 1750. In fact, in 1770, when the United States was, 1776, the United States was formed, this was still considered the solar system for most scientists. And in fact, had you put forth the idea in 1776 that the sun was the center of the solar system, you could have been killed, literally, executed for heresy. In fact, Sir Isaac Newton, when he wrote about this, he put the article that he did away for 25 years until he was on his deathbed before he allowed them to publish it, because he knew that if he hadn't, they would kill him. It was heresy, heresy unto death. 1770. How long ago was that? 240 years? We're not that far from that view. Well, there's been a paradigm shift. And that paradigm shift is like this little chick popping out of the egg and saying, oh, there's a whole new world. Hello? That's a paradigm shift. A paradigm shift is when what you believe to be true is all of a sudden shredded, and guess what? It's no longer true. And now you have to think about it from a whole new standpoint. And that's what we have now, is a paradigm shift that is occurring, and it's occurring in energy. Let me just show you this. This is natural gas. I did this last year, so if you heard me last year, you'll have seen it. But this is what happens with natural gas from 2006 up till now out of dry shale gas production in the United States. That's where we are. That's a paradigm shift. If you'd have told anybody in 2002 that we would have that much times the natural gas that we had in 2002, nobody would have believed you. Look what happens with oil. Yeah, we've had a whole new world develop with us in this fracking business that we're in. This is today's numbers. This came out today at 10 o'clock this morning. 9:30 our time, I think. And what it shows is this is last year's supply of crude oil. This is the amount of crude oil we have in storage. And this is where we are today. So the new year is just starting, and there's the 5-year average. And look at the difference. 100 million barrels. That is a lot of oil. Here's Cushing. Have you ever been to Cushing, Oklahoma? It's just this little bitty town. It's got all these tanks, right? I mean, it's amazing. Everybody talks about Cushing, Oklahoma, but just drive through it. It's like, that was it? But it's got a lot of tanks. But look at where they're at. They're to the point right now that they're talking about, in order to have oil that's deliverable in the futures market, in the crude oil, they're going to have to start putting tankers at sea full of oil. Because Cushing's is full. Here's the weekly crude oil production. This is today's number. And if you'll notice, since oil has traded down close to $30 a barrel, not under it yesterday, as you know, we actually are seeing more oil produced on a daily basis. We're not seeing any kind of a slowdown at all. What about what's happening? Oh, by the way, that equals about the same amount that Saudi Arabia produces on a daily basis. We're not quite to their level, but we're close. Here's Saudi Arabia. You can see they started to come down into the October time frame. There was a little bit of drop in their production. This is where we are right now, and here's what's happened since then. And OPEC has turned on the spigots, and there is no sign that they will turn them off. We do not expect them to turn them off. They're going to continue. And if you look real close here, Saudi Arabia is 32% of the oil that is produced out of OPEC. Now somebody's going to say, yeah, but Dennis, what about this over here? Couldn't this happen? And the answer is probably not. That's where we were when that was occurring. And that's what we now have to back it up. We are, last I heard, there were 2 super tankers that have already left U.S. ports headed for Europe with oil. So we have started exporting oil now to Europe. And the reason is because we don't want Russia or we don't want them to have sources that are restricted. We want them to be able to have some other options. That's a paradigm shift. This isn't going to change anytime soon. Not going to happen anytime soon. When you look at the cheapest barrel to be produced, Saudi Arabia has it at $25 a barrel. Here's the current market right now. And if you look at that, you'll see that other than that, every country that's up there is in a losing situation in the actual cost. But that's not the real thing to look at. The real thing to look at is what these countries have in the form of their budgets. In order to balance their budget, Libya needs 184. Actually, that number's higher now. I got a new number from Wall Street Journal. It's 214, I think. So they need a very high number of oil to balance their budget. Look at Saudi Arabia. They need 104.
That is price per barrel, Dennis?
I'm sorry?
Is that price per barrel?
Price per barrel. That's the price they need per barrel to balance their budget. And there's where the price is right now. So here's what we're up against. We've got a fiscal buffer. In other words, they've got some reserves in these countries. Libya has about a 3-year reserve. They need 215. Algeria's got a 5-year reserve. Saudi Arabia has 5. Iran has a 7. And so this is the price has to change within that period of time, or else they will have used up their reserves. That's the bottom line. So do we need to worry about that? Well, the answer is really simple, yes, for 2 reasons. First is political stability. I want you to look real closely here. Look at these 5 countries. Yeah, they're in a really tough, ISIS has already moved in where there was a void. Believe me, they will do it again really, really quickly. So we've got an issue also between Iran and Saudi Arabia right now, those 2 countries squaring off. So we've got some political instability over there that certainly could have an impact to what we're talking about when it comes to these markets and to oil. So political stability is one reason. The second reason is really what affects you and I as rice farmers, and that's called tracking. Currency tracking occurs when a country has its currency tied to a specific commodity more than anything else. If you look at Australia, their dollar actually tracks iron ore. They're the largest producer of iron ore in the world, and look at how it tracks. So as iron ore prices have declined, what's happened to the Australian dollar? It has declined. Here is the Peruvian sol, and you can see what happens with it, and it tracks copper. But most of the countries out there track crude oil. Watch what happens. Here's Canada. Look at how their currency tracks crude prices. Here is Colombia. Look at how their prices track crude oil. Here's Russia. Look how the ruble tracks crude oil. That is an amazing tracking situation. So as a currency, so their currency is depreciating as oil drops. Now the United States isn't having that, are they? The U.S. dollar has been going up while the crude oil prices have been going down. So we don't track to oil prices. But when we look at the U.S. currency across these other countries, look at the depreciation. This was as of October the 30th. This is when I was starting my my speaking engagements for the winter, and you can see what that was. Now I haven't gone back and changed these to pick them back up and put them on where they belong, but some of these numbers are going to change dramatically. But Russia's down 35%, Colombia's down 29%, Australia down 19%. Big wheat exporting countries. So there's the effect on wheat. Indonesia down 12%. All of these countries have seen this depreciation in their currency, and a lower currency value gives an export advantage to these countries. So Russia has an export advantage to us. U.S. rice and grain prices, when we look at it in the world market, are too high, and that is part of our problem. Look at Argentina. Argentina just got a new president. When the president came out, he was sworn in on December the 16th. The very first thing he did was he let the currency, or the Australian, or the peso float. As soon as it floated, guess what it did? It devaluated 17% in one day. But the other thing he did was he came out and he said there will be no export taxes on corn. And when he did that, that was a 30% export tax. That means that there was a loss of 30% the very same day. So in one day, corn export prices dropped 47%. If you grow corn, you know that that's an impact for exporting, because they had a bunch of corn, a bunch of soybeans that they could start to move in. So do we need to worry about this stuff? Yeah, political stability and currency tracking. 2 good reasons, 2 good things to keep track of for agriculture. Now this is not a funny picture. This is a picture that shows a normal tide change in this area of this is actually over in Europe. But you can see that the boats here are actually made to come down and sit on the ground. And then when the tide comes back in, it comes back up almost to that whole level right there. So just to tell you that a falling tide will lower all boats. And right now that's what we've been seeing. That's what we've been seeing. So, world economy factors, low oil prices are causing major adjustments. We have a higher dollar, which is hurting U.S. ag. ISIS needs to be destroyed very soon. I won't get on a political soapbox, but what we're doing isn't working. And they need to get that resolved over there, or we could have another bigger problem. And we don't need to be sending more troops over there. We don't have to. Oil-producing countries, we've got to be watching them because there's a 5-year window here for possible defaults and some very interesting ramifications to that. Not again in my lifetime. When a Saudi prince comes out and says we won't see $100 a barrel of oil in my lifetime, and he's 47 years old, I can tell you I really agree with him, and I'm not going to see this kind of a line in my lifetime again. A lot of you guys remember that. It's 1974. And that's a big old lit line right there. The first time I did this presentation, a farmer came to me afterwards and said, yeah, but Dennis, think about all the classic car values. So, market analysis, 3-step process. There's the economic environment that we're working in right now. All right? Grain fundamentals. When we talk about grain fundamentals, rice fundamentals, we're going to talk about the trend of supply, the trend of demand, government's activities, and we're going to talk about market psychology or perceptions. This is the long grain rice ending stocks. This was changed yesterday. They raised the ending stocks from 20.8 to 23 million hundredweights on the long grain. You can see that that number is the 4th largest in those 9 years that is sitting there. So we still have a pretty good supply of long grain rice. I know somebody's going to ask me, do I believe the stocks report yesterday? And the answer is, I will trade the stocks report yesterday, obviously. You always trade whatever the report is, right? Do I believe it? Not a chance. This is just very normal in our industry. You just don't trust the December report. It will be adjusted. It almost always is. U.S. long grain usage. You can see our usage is down a little bit in 2015. They cut it from 159 to 157. I think most of that was in the domestic market. U.S. rice production, they actually raised that a little bit. I think we went from 132.2 to 133, right? So it was 0.8, I think. So that was in yesterday's number. So that's up just a little bit as far as U.S. rice production in million hundredweights goes. If you look at that number, though, you can see that's not a high number in comparison to previous years. So how are we doing right now? U.S. export picture. In 2013, on January 1st of 2014, for the 13 crop, we were at 1.7 million metric tons of the exports, 1.8 last year when I was here, and we're now at 1.93. So we're not doing that bad. The exports are not great, but they're certainly not that bad. We're up 129,000 metric tons. When you look at that in the rough rice category, you can see we're 714 in 2014, and we're at 800 at this particular point in time. That's up 85.4 thousand metric tons, which is about 1.88 million hundredweights that we've exported more this time in rough rice than we did last year. I will say this, that part of our competition is almost all milled rice. And so our rough rice market is incredibly, incredibly important. And it needs to be worked on, it needs to be expanded, it needs to be pushed. Especially with this new free trade agreement coming up, the Trans-Pacific Pipeline, because what will happen in that is that Asia is going to get an advantage over us shipping into our markets in what I call our markets in Mexico, in Colombia, those areas. So we know that. I know that for a fact. I'm on the Colombia Free Trade Board of Directors for the Export Trading Company, and they're already talking about that. Here's the world supply, million metric tons. You can see, you kind of look at the supply that we have versus usage. This is usage, and this is the amount of ending stocks that we have. So we're running about a 20%, 22% number. When you look at the world ending stocks by themselves in metric tons, there's 80.5, right? A little bit of an angle for me. 80.5 and 88.4 in this last one. However, there is maybe a little silver lining that can be found in this particular area. This is the ending stocks in million metric tons by country since 2007 for the 5 largest exporting countries in rice. If you look here, watch Thailand. About here we started into the intervention program. Wasn't it 2009, 2010 that that lady was elected? And look at what happened to their ending stocks as it balloons in that rice scheme that they got into. But since 2012, their ending stocks have dropped from 12.8 million metric tons down to 4.9. They produce about 21, so that's about half. They have about half, over 50% of their production was still held in inventory, but now it's down to 4.97. Nice decline right there. Look at India. India, of course, India was one of the countries that really got scared with the 2008 price run-up and the fear for not being able to have rice. So they went out and got some, and look what their stocks did. Now they've kind of figured out, well, we probably can buy it anyway, and they're down to 11.19. Now what's really interesting is if I take this and I add it across. So let me show you that. This is the major exporters' ending stocks, and as you'll see here, we are now below what we were back in 2007. So if there is a silver lining, this is it. I don't want everybody to say he didn't have anything good to say. Okay? So this will be interesting to see how this plays out going forward. You know, world market price, it was unchanged this morning at 922. That's what it is right now. I was going to just mention this real quickly. I get a lot of questions asked about does world market price mean anything, and the answer is really no. But there are a lot of big traders who think that the price futures should be headed for this market, for this level. If the world market price is 922, that's where our futures market should be trading, which is absolutely ridiculous. But that's why there's some big guys in this market for sure. Current world prices compared to last year. This is the current year. This is last year, and you can see that every one of the 5 exporting countries, the prices are lower. If we look at that in an actual table format, you can see that we're 490 in the United States. Last year, when I was here, we were 529. Thailand was 365. This was as of Monday. Vietnam 355. India 360 versus 395. Pakistan 335 versus 345. So prices are down in every one of those exporting countries. Yes, I know supply is down, but so are prices. Prices down $35 to $60 a ton. U.S. is higher by 105 a ton last year. This time they were $104. That's in Thailand, by the way. Sorry, that's the difference between U.S. and Thailand prices, which is something that I have followed for years. So I just keep doing it. All right. So that's what it's. Major exporters in the world: Thailand. They've always pretty much been the leader. Then in 2011, India took over as the higher prices out of Thailand with that stupid intervention program began to affect their exports. You can see that India held on right up until this year. And now they're down, and Thailand has resumed the #1 spot on the exports. So the current rice fundamental issues are this. We have supply declining rapidly. Some of it can be conditioned, by the way, out of Thailand. I think there's a lot of discussion as to how much of that rice over there is fit for human consumption. So there's some condition issues there, but we have seen the supply come down. Production still is adequate in the world, though, and demand is still on the rise. So it's still slowly going up. U.S. dollar and crude oil is going to be a factor. Cuban demand is not likely until 2017. I don't think in an election year we're going to see anybody touch that with a 10-foot pole. And I'll let y'all figure out which candidates are good or bad in that particular regard. We look for more competition from Asia thanks to the Trans-Pacific TPP, Trans-Pacific Partnership. We don't expect that to pass, by the way, for probably 11 or 12 months. That's our opinion. It's not going to. It probably won't happen until a lame duck congressional session. Outlook for other crops supports rice acreage increase. That is a big issue. That is a big issue. U.S. corn numbers. In that regard, I'll just show you this real quickly. U.S. corn numbers. By 2012, we were down to 0.8 billion bushels, so 821 million bushels is a carryover ending stocks. You see now in yesterday's report, we're up to 1.8. Remember that in a minute when I come back. Wheat numbers, we liked it around the 500, 600 million bushel mark. You can see it got down to those levels, and then in that 2010 period of time, we got up to 9.76. Got it back down to 590 just 2 years ago. Everything seemed to be going real well. And then, of course, the U.S. dollar started to have an impact, and that's where we are now. Wheat acres will definitely be down for the year, no question. Here's their export situation in wheat. They've gone from 2011 from 1 million bushels, that's a billion bushels of exports, down to 800 million. So they've lost 250 million bushels in business. And almost all of that is attributed to the U.S. dollar. Soybeans, we've got a few soybean farmers in here. Obviously, the carryover number, 92 million bushels, that was a good number in 2013, supported good prices. You can see what's happened the last 2 years, 440 million bushels. So you're wondering why soybeans are at $8.70 and not able to get back to $9. There's 440 reasons why, right there. Overall, ag fundamentals are bearish. We have large corn stocks, soybeans, much larger world supplies. Obviously, Brazil's got big supplies there. Wheat, larger supplies. The dollar's hurt the U.S. exports, but our acres are down. We know that for a fact. And I think down 2.5 million acres, so that's good. Crop conditions also in question. We've noticed that some of the crop condition reports by the states are showing decline in wheat conditions. So we'll see if that holds up and we get back to USDA's numbers. 2016 is the big acre issue, which we'll talk about real quick. And lower exports are possible with higher dollar lowering demand. That's pretty much in everywhere. We're still thinking the dollar is going to probably move higher over the long term. Outside market factor, we've already talked about oil and the tracking effect. Here's the 2016 U.S. acreage outlook. This is what our guys that we talked to in Chicago are saying. Corn acres will be higher, beans will be about steady, rice acres higher. Y'all hearing that? Same? Y'all hearing rice acres higher in y'all's area? Yeah, they're the same thing. Cotton lower, and wheat is going to be lower. So here's my comment on our acres. We're just doing it to ourselves. So the market analysis, that's pretty much it. We take a look at the economic environment. We've taken a look at the fundamentals. Now we're going to talk a little bit about the technicals. When we talk about technicals, we talk about chart patterns, market indicators, seasonal tendencies, and market participants. Technical indicators are not perfect. Look at number 3. All a technical indicator is the person that uses it realizes when a market has done this in the past, then it usually does this. That's all a technical indicator is. There's no black magic to it. There's no hokey pokey. It's just somebody that studied the lines and said, you know what, I've seen this before. And when this has happened, this has happened. Usually. Does it always happen? Obviously not. Now when I win the lottery tonight, yeah, I don't have a chart that picks that out, so don't worry. But one of the things the technicals do is it helps you get over the bump because it just gives you that idea, hey, maybe some things are happening here. So what I want to do is I want to just walk through one technical, just so you kind of get a picture. I'm not trying to sell anything. I'm not trying to get you hooked on anything. I don't want you to think that they're perfect 100%. I just want you to get an idea of the flavor of what a technical can do and how you can use it. I picked cotton because, well, I've been picking cotton because there's very few people around that I've been going to that are growing cotton. But in this one, there's a lot of you in here I know that probably grow cotton. But if you look at cotton, this is where we were up into December of last year, very sideways market. And this indicator right here in the middle is just one of the 5 indicators that we use to tell us what is happening in the market so that we would know what could happen in the market. And what you'll see is that whenever there's a spike in this indicator, or a valley in this indicator, that it gets associated with a high or a low. So for instance, notice that the lows here are associated with these spikes in this particular indicator. It doesn't always work, no. But it just says that when this happens, then this usually happens. And if you look at the highs, this is the same type of situation. So it's just an indicator that we will follow. It's like I say, it's one of 5 that puts it together and says, we've seen this before, therefore maybe this is what's getting ready to happen. Here is corn, and this is a corn chart that's up to date. If you look right here, there is a reversal that has occurred in this market. In fact, it occurred on January the 6th. I just happened to be in Nebraska speaking that day. So when I got up there and was speaking to those farmers, I said, it happened today. So this is, so I could show them what the indicator actually was and show it to them live with the market. You can see the Dell model sitting down here, and there's a reversal. And that says that there is a chance that when this has happened, the market has bounced back. That's all it says, all right? Now, obviously, I like to be on the sell side. And if you look over here, you can see there's where it occurs on the sell side, and it works there on the sell side. I've got some clients in here, you can ask them, they'll tell you, we sold corn there, and we sold corn there. But not just because this indicator said it, because there were other technical indicators that said, guess what? We've been here before, there's a very good chance that this is getting ready to happen again. So that's what's happening right here in the corn market. If you look at the Chicago wheat, same thing happened. This was actually the one I showed them on January the 6th, and here's where the market is tonight. So that same type of an indicator. So indicators are not something you just throw out the bathwater and say, hey, you know what, it's just a bunch of... It is something that just says, when this has happened, this has happened. Not that it will, but that it has. Here is soybeans, same situation happened on the 6th right here. Barely touched it, but it happened. Here's rice, and this is where we are in the rice market right now. This is today. If you didn't see today, you don't want to see it. But that is today right there. Market broke underneath that support, ran stops, pretty heavy volume. You can see the Dell model is sitting right here in no man's land. It's not down at this level, it's not up at this level, so there's no reason to be doing anything, and that's what our systems tell us here. Because this market is just absolutely dead. It's caught, it's going to have these days, and it's just not going to be doing much of anything. Unless something big is changing fundamentally, which is. So that's what the technicals say as far as the rice is. I do want to show you this though. This is a 20-year historical seasonal tendency of rice. And if you look here, you'll see that we're coming into January right at this point in time. So we have a tendency to be sideways at this point of the year. And then about the end of March, that's when we have a tendency, over the 20-year period of time, we have a tendency to see prices go up. Now, don't trust me on this. The company's called equityclock.com. Write it down, go there, look at it yourself. It's free. Just click on seasonal, commodity, rice, seasonal commodity corn, whatever. It's a great little site and it's absolutely free. They do all the work for you. So here's the rice technical indicators. The patterns from the chart are sideways. The market indicators are sideways. The seasonal tendency is sideways. Market participants. We've got some big shorts in the market, but actually that supports a sideways move. They're not getting out. Even when the market rallied, they did not get out. That supports the sideways move. So, there it is. The economic environment, the fundamentals of the market, the technicals. The economic environment is shaky. The fundamentals are bearish. The technicals on rice are sideways. That's where we're at. Now, the last time I did this a couple of years ago, and I probably say this, I've said it every time I do it now because it was so funny when he did it. It was in Beaumont, Texas. I went through this presentation. It was about an hour long, I think, right at the time. And when I got through, there was a guy that stood up in the back and said, "Hey, Dennis, I didn't understand a word you said. Just tell me what the price of rice is going to do." So for you guys that are like that, let me just say this. I look for rice to be sideways. Imagine that, huh? And low through the second quarter of this year. Price recovery is not likely until 2016 marketing year or into 2017. Unless there is some kind of a big change in Asia. I think, Mo, I just saw you. I think you're talking about that, aren't you?
Yeah, same thing.
So you should go listen to that because that's a key ingredient for us here short term. $14 threshold, that is the obviously the reference price for PLC. I think it's going to take something big to get us to that level. And currently the average is 11.22. They're projecting 11.50 as the average national price. So that means that we are, by the way, we're estimating about 41% of the crop is priced in, maybe a little bit higher than that actually. But that's where we are right now. So right now the PLC payment is expected to be $2.50. Day before yesterday it was $2. Okay? So they raised it 50 cents. I'm kind of bummed out about that because mine, before that, I had $2 and then mine said $2.50. So now they just come to my number. I don't know if they're reading my stuff, but anyway, I'm in agreement. It should be around $2.50. So what I said at the beginning is still true. The economic, you look at these three parts of the stool in your own marketing plan. You need to have these kind of concepts down so that you can check them out. Knowing these three areas are going to help you have a clear picture of what the risk in the market. So I want to close with this picture. If you look at this, this guy just walks up to this group. He just walks up to them. Now, what gives? What does he know that they don't? Or better yet, what do they know that he doesn't? There's some big concerns here, right? Well, The fact of the matter is everything's okay. They're all right. Because you want the clear picture? Here's the clear picture. That's the professor, and those are his students. Paradigm shift. When you see what's actually happening and when you know what's in place, then you can have a pretty good idea of what you should be doing. Good luck. We're all going to need it. That's my email address right there. You've got a question for me, if you feel free. You don't have to be a client of mine to send me a question. I'm more than happy to work with you on any kind of question you might have. Websites, HRM, if you want to. Yes, sir.
I got a big macro question for you since you talked macro. Could you see a situation where the oil price goes way up outside the U.S. and stays low in the U.S. because of our fundamentals?
No.
They'll move together?
They're going to move very close together. The bait is going to be really, really tight.
So they won't shut down crude oil
U.S. shut down? They could, but I don't see them doing that anytime soon. Here's the thing about a paradigm shift. You can't get the chick back in the egg, right? You know, the chick doesn't go back in the egg. But the one thing that could happen here, y'all are familiar with the term fracking, right? How many of you are familiar with the term refracking? Okay, so here's a Google assignment for you. Go check on refracking. Because they are now talking about refracking these wells up to 10 times. And that's why the rig count doesn't need diddly squat anymore. Because they can go in there and frack these wells 2, 3, 4, 5, 6 times and they just keep getting more.
Old wells too.
I'm sorry?
Old wells too.
Yes, that's exactly right. So this fracking thing is now multiplying. There's a lot of guys who don't want to do it because they're scared they might mess up the formation. So back to the chicken, back in the egg. If all of a sudden there's some kind of a big accident somewhere, and there's some kind of a big issue, then all of a sudden we can see Congress come in and say, well, wait a minute, let's slow this fracking thing down. That would be trying to put the chick back in the egg and glue the egg back up. Okay? But that's what it would take to be something like that.
A congressional act.
Yeah. I can't believe it. Is that right? I got a few seconds for more questions if you've got them. Otherwise, I'm done. Any questions? Equity clock. Equity. Think of equity as in I don't have any clock. I'm a rice farmer, so equity, no equity. Any other questions? Yes, sir. The stock market's down today. Yeah, we're bearish the stock market right now. One of the issues that the equity market has is that whenever the government starts to raise interest rates, plain and simple, they're taking money out of the system, and that just means lower capital. And so, as a broad index, the S&P probably should be some downward pressure, but we're not going to go back to 8,000 or anything like that on the down. We're not big bears, but short term, yeah, we think it could be down. We actually were wrong today. We thought we'd have a bounce today. So we got a bounce early. We're up over 100 points at one time before it goes down to 300. So yeah.
You're talking about a possible recession. Would that help us from this standpoint because it would make us more competitive in the world market?
It's amazing, but agriculture seems to have has a better situation coming out of or during a recession.
Soybeans now through SX6.
I actually have a slide on that I'd be glad to show you afterwards. Does anybody have a question? Another question, or I'll just do it real quick. If you can, I think I left that in here. This is the. Sorry. This was the corn range for 2016, where the market was at 378. We see a high possible of 465, a low of 335. That's with a high yield. Soybeans, 876 is where they were when we did this. We're seeing a possible move to 1055 on a weather scare. We think that that could actually occur. When you're going from El Nino to La Nina, then there is the possibility that we could see, if it happens right, you could actually see some changes in the weather. So we could see a weather scare that bounces that high. I'd sure be selling a bunch before I got there. At $8 on the low side, assuming a 47 bushel.
What about the okra?
Old crop. Okay, on the old crop. Let's see, beans through November, this is for November 2015, it was $9.90. This is what we said we thought it could do, and this is what it actually did. Yield was 47. 2015 beans through May is all I've done. Market trade at 865. We see 915 as a possible high side. We still like that number. I didn't show the soybean chart, but the soybeans have some very strong technical indicators here. Very strong technical indicators. Did I show you that? I didn't show you that, did I? I'm just saying.
Did you show one like that for rice?
I did show on like this one here.
Yes, sir. Market outlook for, well, like for 16 rice price.
No, I didn't do that. I have that, but I didn't see. Yeah, get $12 the high, $11 the low, and just stretch it out as far as it goes. That's kind of where we're at on that one. Let me see if I can find the soybean chart for you, though. It is a very interesting chart that is occurring here in the soybeans. If I've got it, here it is. From a chart standpoint, if you'll look here, you see that low right there? There's a reversal right here. There's a reversal right here. This is a real strong low section right here for the soybeans. So we got 3 reversals that are working in this price range that make it a very interesting situation. And you could get a bounce here back up towards the $9 mark. So, and I didn't if you're are there soybeans people in here? Let me just. Oh, unfortunately. Hold on a second. I think I have the seasonal tendency for beans, which might be something I'd like to see. Then again, maybe I don't. No, I don't. I took it out here. But I can show you that afterwards. Anybody wants to see that, I'll be glad to pull that up and show it to you. What you'll see is the soybeans have a tendency to start to go up right now in the time frame. This is the bean normal seasonal tendency over 20 years. They start to move higher.
Do you think that $14 threshold affects our real price?
I have to say yes. I think that there is a perception of yes. Because think of it this way, most of you guys at under $14, you should be very slow to market price. Because that PLC is not guaranteed. If you sell a bunch of rice and all of a sudden the market shoots up, you sell at 11 thinking there's going to be a $3 PLC, the next thing you know we're at 16 because something happened somewhere.
Okay, but by that thinking, last year never reached target price. So we would still have it.
Yeah, but now you start, well, okay, yes, but remember, as you move through the year, we're 41% sold as far as the national average goes, so you should be close to 41% sold if you're worried about PLC. And if you're thinking about PLC hedges on the long side, you shouldn't be long any more than 59% of your crop to protect it. So you just adjust that as that moves.
I've had people say, why are you selling anything under the target? Well, it never reached target last year, so I'd have last year's crop and this year. I'd probably be in prison for in debtor's prison.
Well, I think that once you have a pretty good idea that the market's going to hold at a particular level and you're going to have a PLC payment that's a certain level, I think then it behooves you to at least start not to be worried about going back to $14. You start selling rallies, and you can sell rallies. Yes, sir.
For the sake of that 41% sold on the 15 crop, so much of the 14 crop is sold at 14. How much of that 14 price
If it's after that month calculation, zero. So in other words, they only take what they know is marketed during that crop year, marketing year, percentage-wise. So if there's 14 crop that has not been, obviously, you and I both already been paid PLC, so it doesn't matter. Once we get to the end of the marketing year, it's done, it's over.
So they carried none of that volume.
None of it over. No.
So it's time track.
That's right.
Is there enough of, follow up on Rick's question, is there enough 14 carryover? Like a friend of mine just sold his 15 and 14 crop last year, 100%. Is there enough of that to be impacted in the 15 PLC also?
Probably not. I think that the amount of, I know the amount that was, Stuart may have better, I can verify for you. But I know that the amount that went into the calculation was 133 million hundredweights last year. So obviously we grew more than that. So there's stuff that's outside of it. And I can't tell you that it's very possible they could have had some rice that was carried over from 13 and up to the 14 numbers. I don't know. It's not supposed to happen that way. They're not supposed to do that.
So, but we do know how many hundredweight they used.
Yes, they used 133 million. If you don't know how to get that number or find that, okay, write this down. Rice Outlook, USDA. The guy's name is Nathan Childs. He publishes it every month. Where you are, where we're at, everything else. And then the USDA also puts it out. I mean, we already had the December number long before the report came out for January. They already, or November, I guess. They gave us the November number early. So they'll send it out early from the chief of the Congress office. But yeah, we know exactly how many hundredweights they put in. I told you I found the useless information.
So the follow-up question on that.
Yes.
138.
133.
133. So how much was actually produced? I know that number somewhere.
100 and, somebody tell me what it was. Was it 160? 160 million? It was 150. Yeah, yes, you're right, 160. Yeah, I think that's right, 160. I'm trying to go back and find that. Thank you, guys.
So should I take all my farm money and just buy gold?